In the Canadian professional services industry, business operations rely on two separate, yet equally critical components: the rules that process the work, and the judgment that ensures it's right. When one consumes the other, we investigate. These are the case files.
So here's the thing about accounting firms. They all do the same work. Documents come in, someone pulls out the numbers, someone else categorizes them, and then a third person checks it all. And this happens hundreds of times across dozens of clients every single month. The people who should be out there advising their clients? They're stuck entering data. So the firm came to us and said, look, how much of this is actually rules and how much of it requires real judgment? Because that answer, that changes everything about how you staff the work. Undisclosed is a Canadian accounting practice based in Ontario. They do what most accounting firms do: bookkeeping for business clients, financial statements, tax filings, and advisory when the numbers show something worth talking about. The clients are small to mid-sized businesses, retail, professional services, trades. Each one sends in bank statements, credit card statements, receipts, and invoices, monthly for most. The firm's job is to take all that raw financial data, organize it, verify it, and deliver clean books the client can rely on, and the CRA can audit. Now, this is not a tech company experimenting with AI. This is a traditional professional services firm asking a very practical question. Can the rules-based part of bookkeeping be handled by a machine? And if it can, what does the human's job become? Before you can answer that, you have to see the work. Not the job description, not the org chart. The actual work, step by step. Here's how bookkeeping actually works at the transaction level. Not the textbook version, the real version. We use a framework called the AI Deployment Map. 6 stages. Every workflow in every business moves through some version of these stages. Intake. Documents arrive. Bank statements as CSVs or PDFs, credit card statements, receipts, sometimes scanned, sometimes photographed, sometimes a crumpled piece of paper someone found in their truck, invoices from vendors. The first job is just getting these into a consistent format. That sounds simple, until you realize every bank, every credit card company, and every vendor formats their documents differently. Prepare, now you normalize. Dates need to be in the same format. Vendor names need to be cleaned. AMZN MKTPCA *2K7X4M1 needs to become Amazon. Dollar amounts get separated from tax components. Receipts get matched to bank transactions. Here's a real example from the sample data. The bank statement shows Staples number 4422 Mississauga for $127.43. The receipt shows a subtotal of $110.77 with HST of $16.66. But 13% of $110.77 is $14.40. That's a $2.26 discrepancy on the receipt from Staples. Someone has to notice that. Someone has to flag it. Produce. This is the core work. Every transaction gets categorized against the chart of accounts. Bell Canada for $189.95 goes to telephone and internet. Google Ads for $450 goes to advertising. Tim Hortons for $14.75 goes to meals and entertainment. Simple, right? Until you hit a $612.87 charge at Home Depot. The receipt shows a DeWalt drill kit at $349.99. Screws and anchors, paint, caulking. The drill kit alone raises a question. Is that an equipment purchase that gets capitalized, or a supply expense that gets written off? The total's over $500, but the individual items are under. Where's the line? Or a deposit? The bank statement says, deposit, client payment for $5,000. No client name? No invoice number? It's a round number. Could be revenue, could be a loan, could be an owner contribution. The bank statement doesn't tell you. Verify, check the balances, detect duplicates, flag outliers. Make sure debits and credits reconcile. Ensure HST is calculated correctly. Every categorization needs to hold up to a CPA's review and potentially a CRA audit. Deliver, format the output for the client or for filing. Clean books, ready for financial statements. Knowledge, this is the stage most firms skip. What did we learn from this batch? Which vendors are new? Which categorization patterns should be remembered for next time? Usually the knowledge stays in people's heads, not in systems. Now multiply this. 22 transactions in 1 month for one client. Dozens of clients, 12 months a year. thousands of categorization decisions, each one requiring the same structured judgment. The work is structured, it follows rules, but the rules live in people's heads. So where does the time actually go? We use a diagnostic called the Friction Hunter 5 test. You're looking for where staff hours disappear without producing proportional value. At undisclosed, the friction profile is clear. Document ingestion is heavy. Multiple clients, multiple banks, multiple formats. Every batch requires manual normalization before the real work even starts. The rules are well defined. A chart of accounts is explicit. Tax codes are explicit, but they're applied by hand, every time, by a human reading each transaction and making the same decisions their colleague made last month for the same vendor. Verification requirements are high. This is accounting. A CPA signs off. The CRA can audit. Every number has to be right. But verification is different from production. Checking a draft is faster than building one. The result is an inverted time allocation. The accountants, the experts, spend more hours on data entry than on analysis and advisory. The judgment work, the work only they can do, gets squeezed into whatever time is left after the data entry is done. We score every workflow we assess. The AI leverage score runs on 4 dimensions, each rated 1 to 5. Frequency, rules clarity, verification ease, and time cost. Undisclosed transaction categorization pipeline scores 17 out of 20. That puts it squarely in what we call the strong AI leverage zone. Anything above 14 is a strong candidate. This is one of the highest scoring workflows we've assessed. But a score doesn't tell you what to build. For that, you need to see where the rules end and the judgment begins. The step that separates a useful AI deployment from a failed one is decomposition. You take the workflow apart, every task, every decision, every handoff, and you ask, is this rules or is this judgment? On the rules side, data extraction, pulling dates, amounts, vendor names, and tax components out of documents. That's pattern recognition against a known structure, rules. Format normalization, converting January 5, 2026 and 2026-01-05 and 01/05/26 into the same format. Rules. Transaction categorization against a chart of accounts. When Bell Canada shows up for $189.95, it goes to telephone and internet. When Google Ads shows up for $450, it goes to advertising. There's a defined mapping, rules. Duplicate detection, balance checks, tax rate validation, these are arithmetic and pattern matching. Rules. On the judgment side, ambiguous categorizations. That Home Depot charge with the drill kit. New vendors the system has never seen. Unusual transactions that don't fit the pattern. Period-end adjustments. Materiality decisions. When an accountant decides that a $2.26 HST discrepancy on a receipt matters or doesn't matter. Client communication. Explaining the books. Answering questions about what the numbers mean. Financial statement sign-off. The professional opinion that says these books are correct. 3 questions cut through the noise. We call it the readiness test. Does this work repeat frequently? Yes. Every client, every period. Is the first pass rules-based? Yes. The majority of categorizations follow a chart of accounts with clear mappings. Can a human easily verify the result? Yes. An accountant reviewing a categorized draft is significantly faster than an accountant building the draft from scratch. The redesigned workflow is 4 steps. Ingest, AI first draft, human verify, release. The AI doesn't replace the accountant. It gives the accountant a draft instead of a blank page. The expert's time shifts, from data entry to review, from production to judgment. That is the opportunity. Here's what was actually built. The system is a 6-stage pipeline, the same 6 stages from the deployment map, now implemented as an operational system. Intake, prepare, produce, verify, deliver, knowledge. Each stage has its own workspace. Files move through the pipeline in order. Any session can pick up where the last one left off. If the system stops in the middle of produce, the next session finds the batch right there and continues. But the pipeline itself is not the interesting part. Pipelines are plumbing. What makes this system different is what it records while it works. There are 3 rules. They are non-negotiable. No output leaves without a trace. No decision is made without a logged reason. No categorization happens without showing every signal that was evaluated. The system doesn't just do the works, it shows its work. Every step, every decision, every uncertainty. That is what we need to look at. The This is a processing trace. It's the complete decision record for one batch of 22 transactions processed through the pipeline. Every trace has a header: batch ID, period, transaction count, status. Then it has entries. Each entry is numbered: T-001, T-002, T-003, and so on. This batch generated 36 decision entries for 22 transactions. Some transactions required multiple decisions. Each entry has the same structure: a timestamp, the input being evaluated, what was considered, the decision, the confidence level, the reasoning, and any flags for accountant attention. Let me show you what this looks like in practice. Entry T-008. Bell Canada, $189.95. The system evaluates 5 signals in priority order. Client-specific rules. None exist yet. This is the first run. Vendor mapping. Bell Canada maps to telephone and internet in the knowledge base. Historical pattern. No history for this client. Keyword match. Bell Canada contains a telecom pattern. Amount pattern. $189.95 is consistent with a monthly telecom bill. Decision. Telephone and internet. Account 6450. Confidence. High. 2 strong signals aligned. No contradicting signals. That's what a clean categorization looks like. Most of the 22 transactions look like this. But the interesting entries are the ones where the system stops. Entry T-009. Deposit, client payment, $5,000, credit to the account. The system evaluates the same 5 signals. No client rules, no vendor mapping. This is a deposit, not a vendor. No history. The description says client payment but provides no client name, no invoice number. The amount is round, which could indicate a loan or owner contribution rather than a revenue payment. Decision, flag, confidence, low. The system explicitly states what it cannot determine and what additional information the accountant needs to resolve it. It doesn't guess. It doesn't default to revenue, it flags. Entry T-012. Staples, $127.43. The categorization itself is straightforward. Office supplies, account 6250. But during the verify stage, the system cross-references the receipt. The receipt shows a subtotal of $110.77 and HST of $16.66. Standard HST on $110.77 is $14.40. The system catches the $2.26 discrepancy and flags it. This is a real operational catch, not theoretical. The receipt has a number that doesn't match the math. A human scanning 200 receipts in a batch might miss it. The system does not. Entry T-015. Home Depot, $612.87. The receipt shows a DeWalt drill kit at $349.99, screws and anchors, paint, caulking. The total exceeds $500, which raises the capitalization question. Is the drill kit equipment or expense? The individual items are under typical capitalization thresholds, but the kit alone is $349.99. The system flags this for accountant review. It notes the specific ambiguity. Total over $500. DeWalt drill kit may require capitalization treatment. Individual supply items are clearly expense. Recommend accountant determine capitalization policy for this client. This is what we mean when we say the AI shows its work. Not a confidence percentage on a dashboard. Not a green checkbox. The actual reasoning, entry by entry, for every decision and every uncertainty. You can read it. You can audit it. You can point to a specific transaction and see exactly what the system considered, what it decided, and why. At the end of the trace, there's a decision summary. Out of 22 transactions in this first run, 55% were categorized at high confidence. The rest were medium, low, or flag. 55% on the first run, with 0 client-specific rules, 0 history, 0 corrections to learn from. That number matters. It's the starting point of an arc. The system uses 4 confidence levels. High means multiple signals agree. Medium means one strong signal with no contradiction. Low means the system is guessing from keywords alone. Flag means the system will not guess at all. On the first run, 55% high. That's the cold start. The system has never seen this client's data before. No client-specific rules, no correction history, no patterns. But every batch process teaches the system. When an accountant corrects a low categorization, that correction gets logged as a knowledge entry. The vendor mapping gets updated. If the correction applies to a pattern, it becomes a candidate for a client-specific rule. After the accountant approves those rules, the next batch benefits. The same vendor, the same pattern, now categorized correctly with high confidence. The arc from 55 to 90% or higher is not magic. It's organizational knowledge being captured and applied systematically. The rules that used to live only in an accountant's head now live in a system that remembers them for every future batch. The accountant's job shifts. In the first few batches, they're teaching, correcting categorizations, approving rules, building the knowledge base. Each correction makes the next batch faster. By batch 5 or 6, the system handles the routine work and the accountant focuses on the exceptions, the ambiguities, the judgment calls, the work that only they can do. The trace system records every decision, but records only matter if they cannot be changed after the fact. This is accounting. Auditability is not optional. The integrity system has 4 layers. Layer 1. Every finalized trace gets a SHA-256 hash, a cryptographic fingerprint. Change one character in the file and the hash changes completely. Layer 2. Each trace includes the hash of the previous trace, a chain. If someone alters an earlier trace, every link after it breaks. You cannot change the past without the present knowing. Layer 3. A manifest file records every trace's hash, timestamp, and position in the chain, an independent record that the chain can be verified against. Layer 4. Traces are synced to Wasabi cloud storage in Canada using object lock. Write once, read many. The storage provider enforces immutability at the hardware level. Not even the account owner can delete or modify a locked object until the retention period expires. 7 years for CRA compliance. Here's what tamper detection looks like. This is a verified trace. We change one categorization, one line, run the verification script. The chain breaks. Hash mismatch detected. The system tells you exactly which file was altered. We restore the original. Run verification again. Chain intact. Canada's proposed AI legislation, AIDA, died in January 2025 when Parliament prorogued. The law doesn't exist, but the principles behind it, transparency, human oversight, impact assessment, those principles are not going away. The trace system already meets them. Every decision is transparent. Every batch has human oversight in the verification stage. The integrity chain provides an impact record. Building to those standards now, before regulation requires it, is what forward compliance looks like. What changed? Structurally, undisclosed moves from tasks-level operation to workflow-level operation. On the AI installation pyramid, that's the shift from ad hoc tool use to a structured system where AI handles the first pass and humans handle the judgment. Before, accountants start from a blank page every batch. The rules for categorization live in their heads. The audit trail is whatever the spreadsheet remembers. Every new staff member has to learn the patterns from scratch. After, the system delivers a draft. The accountant reviews, corrects, and approves. Every correction teaches the system. Every pattern is captured. Every decision is traceable. The knowledge compounds. Doesn't walk out the door when someone leaves. For the firm, the math is simple. If the system handles the routine 55% on the first run, and that climbs to 85 or 90% over the first few months, the accountant's time allocation inverts. Instead of spending most of their hours on data entry and a fraction on advisory, they spend a fraction on review and most of their hours on the work that requires their expertise. That's not an efficiency gain. That's a structural change in what the firm's capacity is used for. This was case file number 1, a scaffolding run, sample data, no live client files. The work behind this case was done by Empower IT. If you want your workflow analyzed in a future case file, send an email to cases@empowerit.ca. Until then,